The market is on pins and needles ahead of the Fed decision and will be looking for more clarity from the central bank with respect to the policy normalization outlook. Perhaps, somewhat ironically, the one thing that won't be on anyone's mind is whether or not the Fed hikes rates today with a 25 basis point hike already fully priced in. And yet, there's a whole lot of risk associated with today's meeting that will need to be considered as the market scrambles to adjust to the latest monetary policy update. The biggest question is the question of the number of rate hikes in total that we should expect this year. The market has been looking for 3, though, between a Fed that has been very close to signaling 4 rate hikes as per that dot plot and economic data that seems to back this up. We could see a decision today that results in a repricing of expectations to account for another rate hike. The dollar has already been finding demand in the lead up, with chatter making the rounds that the Fed chair will go ahead and drop the language referencing accommodative policy. But as we look at the event risk, there are 3 important takeaways that come to mind. The first takeaway is that there has most definitely been a type of paradigm shift over the past year and a half in which market bets that the Fed will underdeliver when it comes to hawkish projections are no longer paying off. In 2017, the Fed delivered the 3 rate hikes they said they would, despite calls for only 2, and now in 2018, we've seen things move a step further, with the market okay with the Fed's calls for 3, but now needing to contend with the possibility of 4 rate hikes. On the surface, this is certainly a dollar supportive development as it relates to US dollar yield differentials, but this also takes us into a second very important takeaway, which is the fact that since 2017, the market has been hit with a new complexity when it comes to assessing currency risk, and that complexity is the U.S. administration and its imposed will on the FX market by way of a protectionist platform necessitating soft dollar policy. And so this second takeaway is important because as much as the dollar may want to rally on ramped up Fed policy normalization, it will be discouraged from making any meaningful appreciation on account of the U.S. administration's policy. The final takeaway for us as we head into the risk is that, given the points above, we think any fallout from a more hawkish-leaning Fed decision will be fallout that will pose a much deeper risk to U.S. equities, still trading just off record highs at a time when the free money incentives to be long stocks are no longer there and only moving in a direction that is sure to make things a lot more uncomfortable for investors. That static Fed equity market valuation model, which still shows stocks undervalued relative to the 10-year, will start moving hard and fast if the Fed does in fact start to move into that hawkish territory faster than the market thinks it will. Now, there are some other considerations today that should be accounted for. One of these is the issue of the interest rate on excess reserves and whether the Fed will do something that caught the market by surprise in the last minutes, in which the Fed talked about raising this rate by only 20 basis points as a way of seemingly creating a creative way of keeping the normalization process from getting too aggressive. If executed, this would be dollar bearish. The final consideration is the consideration of this possibility that the Fed will hold press conferences at every meeting going forward. If this change is made, it is also potentially viewed as a dollar bullish development, as it makes every meeting a live meeting that could result in a rate hike. But as we wrap up this update, we believe the biggest takeaway going forward is the offsetting impact U.S. protectionism poses to central bank moves that favor the dollar on a yield differential basis. One final insight of a different nature, which is how all of this could impact the cryptocurrency market. If we're to isolate the 2 biggest cryptocurrencies, we would say that a risk environment in which a more aggressive Fed policy weighs on global equities is an environment that should also weigh on crypto. In a time we could get where the market sees crypto as a safe haven alternative, but at this stage in the game, we still view the asset class as risky relative to traditional assets. However, we would also say that within crypto, in the event of a capitulation in global equities, the store of value lure of Bitcoin should make it far more attractive than Ether, which has been the currency used within an ecosystem of thousands of new ventures that have yet to go anywhere at all for the most part and have yet to really prove their concept. And so we see ETH as the riskier asset and Bitcoin outperforming relative to its cousin in such a scenario. That's all for now.